Welcome everybody. This is Joseph Ixu with Premier Council Realty, and today we're going on our spotlight to cover the March 2022 market update. And you probably have seen a lot of news regarding the market here recently, and it's still a busy market. It's still a hot market. There's still a lot of people buying and a lot of people selling. Not as much selling, but there is a lot of movement in the market right now. And really, everything has to do with how inflation is affecting us, on a basis, a personal basis, and also in the market. Okay, because it is very busy out there right now. Prices are going up everywhere, including at the gas pump, as you already know. And when it used to take $25, it's now taking $50 to fill up your tank, and it's getting more expensive every day. But today we're going to be talking about how home ownership is actually a hedge against inflation, and we're going to go into detail in the market and kind of give you an idea of why it's such a great idea to own a home. Okay, so there's actually two things you're going to be doing, right? You're either going to be buying or owning a home or renting a home. So let's talk about buying, and we're going to compare it to renting as as the time goes by here with this presentation. Okay, so we're going to take it away. Take it away, Johnny. All right. So, like I told you earlier, home ownership is a hedge against inflation. And we're going to go ahead and get started with this slide to kind of give you an idea of how this is a great idea to purchase a home. Okay. So if we take a look at the home price appreciation versus the consumer price increases over the decades, if you started back at 1970, okay, the inflation rate in 1970 was 7.1. Sounds kind of like what's going on right now. But home price appreciation was at 9.9. Okay, so relatively higher than the inflation rate. Now, there's been a couple of decades. The 1980 is one, and then the 2000s where the numbers were pretty close, if not where inflation was a little bit higher than the actual price appreciation of a home. However, as we gather or we moved away from the 2000s, like the 2010s, the 2020s, and now in the 2021s, as you can tell, like for example, at 6.8% in 2021, houses appreciated at 18%. So, on average, right now, people have about $54,000 in equity sitting in their home right now. So, houses have appreciated very high, and basically it's a great investment if you look at it as an investment to hold your wealth, which is one of those factors that you consider when you're buying a home. Okay, now this is from Mark P. Cousin, the financial writer at Investopedia. It says real estate is one of the time-honored inflation hedges. It's a tangible asset, and those tend to hold their value when inflation reigns. Unlike paper assets, more specifically, as price rise, so do property values. Okay, so that is an excellent point, because if we look at the back at the at the 2000, specifically if we think about what happened during the 2008 financial crisis, I want you guys to consider that there's a couple factors that were different back then. Okay, and I have them up on the screen. But relatively speaking, okay, in this time frame, we had too many houses. Okay, too many houses, and at that time, this is where the government started creating government-sponsored entities, or GSEs, and I'll give you a couple of those. Okay, Fannie Mae, Freddie Mac. Those are a couple of those entities that were actually established. And basically what they would do is make it easier for homeowners to purchase houses. Okay, and that goes directly to the lending standards. There were certain lenders and certain programs that will allow, individuals that were not as qualified to purchase a home to purchase a home. And then when the economy started, going down, or there was concerns in different job markets and so forth, people were losing their jobs, and they were not able to afford the houses because they were buying too much house. Because some of these programs allow them to put money down for them. Also, there's different entities within the cities that will help them with money down programs. That caused a very, very hard time for individuals that were in those situations. And on top of that, because there were so many houses on the market, okay, and not enough buyers, this was creating buyers. But at the same time, when you have too much houses, then becomes a buyer's market, right? So the houses tend to go down. So that relates to the low to no equity, because the prices were so low, and it takes typically about 2.5 years to kind of start earning equity on a home. Then individuals had low to no equity on their houses, so they couldn't really sell them, okay, and get that money out of the house to help them through the hard times, okay. And today's market is really different when it comes to this particular aspect of the economy. I want to kind of give you an idea of where we've been. So back in the 1990s, and I picked this time frame is because when I was still in the military, in the Air Force, I was in the Gulf War during the 1990s. I was there in 1991, 1992. And so, it's always interesting to me to find out what was happening in the housing market at that time. So, home ownership in the 1990s was a 63.9%. In the 2000s, the very time frame that we were talking about just now, was a 67.4%. Okay, so what were the differences? Okay, so at that time there was a little bit higher income, better employment opportunities, and baby movers were reaching the prime buying season, okay, or the prime buying years. We go through a cycle. Obviously, it's like a bell curve. Okay, you start going up, you start, growing and getting older. Your income's low at the beginning, and then starts getting bigger and bigger and bigger. And then when you get to their 60s and 50s and 60s, your income and also your drive starts going down, and you just don't feel like doing anything. But so a couple of things that were actually really, really in in the news at that time, that for example, in 1994, African American home ownership started at 41.2%. Okay, in the 2000s, we were at 47.26%. In the 2004s, we're at 49.1%, and then in 2006, we're at 59.9%. Okay, so that in itself was not a big factor, but the issue is the affordability factor and also the lending standards, because a lot of individuals, not just African Americans, but also different groups within the society, were not as qualified to purchase, which this created the subprime lending industry. So at certain time frames, you had to have a particular score for your credit score, and then the subprime was below that, so that created a new industry to help those individuals purchase homes. Okay, and it went across the society, so it was not just one particular group. But in the 1999s, the GSEs that I were talking about, increased the increased credit worthiness, and purchased subprime loans, which basically had a higher risk and lower credit score. So this helped get to the 2008 issue. And so we're going to be talking a little bit about what's happening now, comparing it to this particular era. So I wanted to talk a little bit about that before we move forward. Okay, so but real estate gets more valuable because as the economy gets better, and also if or inflation starts rising, then home prices starts rising too. And particularly in this particular market, because we're such a seller's market right now, there's not enough homes for the amount of people that are actually looking for a home. then that drives the prices up. Okay. In certain communities and certain cities, we're like less than a month of inventory. So it's taking less than 1 month, okay, to sell every single house in that market based on, market data. Okay. So prices are going up everywhere. You felt that from the pump to the grocery store. For home ownership, and rentals are not immune to the prices that are going up. And so, we call it inflation. And today's prices are really going off the rails. Okay. So homeownership is outperforming inflation over time. We kind of just showed you that slide just recently. And when an asset outperforms inflation, that's where you want to be. So the houses are appreciating pretty high today. I think one report that I saw was like people have a minimum of $54,000 in equity in their home as of today. Okay. So one of the other things that home ownership does, it maintains the same expenses. Think about this, okay? You're actually locking in your payment at a certain interest rate for a certain amount of time. Now, obviously, some of the things that may go up and down, it's actually your insurance and your taxes, but your principal and interest, basically, your principal will go down with every payment. Your interest will remain the same because it's a fixed rate across how many years you financed it for, whether it be 30 or 15 or 20. And so that continues to build equity on your home. Now, if you take a look at this particular slide, the increase between inflation and rental, okay, rental prices appreciation and core inflation rate from 1973 to 2020. I told somebody earlier today that, the numbers don't lie. They can be manipulated, but when you look it up on a graph, and kind of shows you exactly what's been happening. If you look at the blue line is core inflation rate. The orange line is the rental price appreciation. Now, if you take a look at this chart, the rentals has going up and down, but primarily there's been only several couple of dips that actually went under inflation, and they just spiked right up. That's what's going on right now. Right now, rentals are going up, and just like home prices, they continue to increase. And if my concern is that if the prices or the rates of mortgage rates continue to increase, it's going to price people out of a home because they may be minimally qualified now to purchase, and if the interest rates goes up, it'll put them in a different price bracket, and they may not be able to qualify for a home at that time. Okay, so the rent increases is greater than inflation. But to show you the chart, increases rent and increases home at the same time. Rental prices have increased faster than the inflation rate, and home ownership locks your expenses at the time that you purchase your home. So that's a very easy process and a very easy, thing to get in your mind is that you're going to lock the price of that monthly payment for your housing. And that doesn't include cars and insurance and all kinds of other stuff, electrical, garbage, and all this other stuff that comes in with your house payment, because it's a monthly basis. But as far as the biggest factor that goes into play here is your rental, well, not your rental, but your mortgage payment. And we get to lock it in at a certain price range. So, if you buy it today, it will lock it at today's market value. And this protects you against the rising cost of inflation, which is the biggest part of your monthly payments when you really think about it. Okay. So let me see. I'm going to show you the slide here. Okay. So based on Natalie Campisi, the advisor of Stubbs at Forbes, it tells you that homeowners are shielded from mounting rental prices because their cost is fixed. That's what we've been just mentioning. Regardless of what is happening in the market, tangible assets like real estate get more valuable over time, which makes buying a home a good way to spend your money during inflationary times. So, you're basically putting money aside and watching it grow. Because right now, if you keep money in the bank, for example, a savings account, minimally any interest at all. If you look at bonds, they might be paying 2%, but inflation is like 7%, so you're -4. So it's really, really a difficult time to use those kind of factors in the play. So real estate tends to outperform inflation, which is a good hedge for your money. Okay, so cumulative house appreciations by 2026. So this is a chart that was actually put together by some economists. Now, obviously, economists, just like people, are we have a spectrum, right? We have positive and negative people. So we have optimists and pessimists. So what they've done is they look at the optimists and the pessimists on the prices to increase. And if you look at the optimists, they're saying that the house will appreciate by 2026 at 62.5%. That's crazy, right? Well, wait till I show you some numbers of what the properties have been doing since they've been watching these numbers go up. This is nothing compared to that. Okay, so the pessimist says 23.7. Okay, so very, very interesting data. And overall, we're looking at probably a 43.3% increase in house prices by 2026, which that in itself, it's a pretty amazing fact. So that means that your house will triple in value. I mean, right now you probably double. Now in the next couple of years, it will triple in value. That is not something that when you're going to buy a house, you want to face. But when you want to sell it, yeah, that's pretty nice. It's a double-edged sword, to be honest with you. So, what's going to happen if the mortgage rates resume up? And that's really what they're saying is going to happen. Inflation is all around us, and it's getting more expensive to purchase anything. Okay, historically, we've had good financing. Right now, even if we're at 5%, we're still lower than when I purchased a house back in the 2006, when it was like 8% with excellent credit. Okay, so we have historically low prices. Now, one of the things that really is hampering us is, our thinking, because we're used to low interest rates. So we're used to pay the Fed charging zero interest rate to lenders, and then the lenders charging in the twos and the threes, and now we're like thinking, oh, man, we're gonna go to six or a five. Even at four, we're kind of going off the roof. Okay, so it's really, really difficult to kind of gauge what's going to happen. But one thing is for sure, every economist, every mortgage lender that we've talked to, that we brought on this show, has mentioned that the prices are increasing. So it's a very good time to actually get into a house early, or rather than later in this year, so that you can actually enjoy, the lower interest rates that we've been used to, because they are going up. And according to many economists and also to different reporters that we've actually talked to and lenders across the board. Okay. So let me show you this chart. Okay. Current mortgage rates compared to the last 5 decades. Now, I think that 3.55, that's an optimist view, because I think we're already over 4 right now. But in the 1970s, look at that, 8.66, 1980s, 12.7, 1990s, 8.12, 2000s, 6.27, in 2010 we were at 4.09. So as you can see, even if we go as high as 5, we're still lower than the 2000s. And that's no excuse, and I'm not trying to make it look any better than it is, but it is relatively lower than we've been facing previously in different decades, as you can tell by this chart. So we can definitely rest assured that we have some ease of mind when it comes to those interest rates. Okay, so what really guides the interest rates? We've been talking to many. I've actually had 3 different lenders on the show. We've talked to Terry Bennett, to David Mendez, and to also a new construction, Yanni Ayala, where we talked about the new construction industry. And all of these houses, all of the interest rates that they were referencing was guided by the 10-year Treasury note. Okay, so what's basically what's basically happened is it's based on the yield. Okay, so where the 10-year Treasury notes, so do 30-year fixed rates. Okay, as you can tell by this chart, we're almost at 2%, and I think we're over 2 right now. I was listening to a podcast this morning. They were referencing the Treasury note increasing over 2. So relationship between mortgage rates and the 10-year Treasury yield over the last 50 years. As you can see, the differences have been 1.7%. Uh, so that's really, really close. Look at those numbers. I mean, so this is where we're talking about how the 30-year fix is following the 10-year treasury note. Okay. So that's the numbers there for you to follow. Okay, because as the treasury note goes up, so does the 30-year mortgage rate. Okay. However, rest assured, I don't believe we're facing a housing bubble, and there's many other experts that feel the same way. And it's because of the data and because of the amount of activity that I see in the field and just the demand that we have for houses. Now, there are many people that are staying put where they're at. Okay. There are people that are saying, hey, you know what? I'm happy where I'm at. I don't need to purchase a new house. We've actually renovated or we've actually liked the payments that we have. I'm not sure if we're going to take the equity out now or just wait to see what happens in the market. That's one point of view. The other point of view is like, hey, I need to buy now before it gets more expensive. Okay. So everything depends on you. I had a client ask me, it's like, hey, when's the best time to buy or sell a house? And I said, when you are ready to buy and sell a house, because if you try to time the market, then you're gonna miss. But if you act on when the need is, then it's gonna meet your particular needs, and that's what it's all about. Okay, whether the market's up or down. Okay, if you need to sell, you're gonna sell. If you need to buy, you're gonna buy. It's that simple. So let me see. If we look at the forbearance, okay, so this is why I was telling you that I don't. We're not in the same market as the 2000s, even the 2008s, where we actually had a financial crisis. Because in those days there were high. I mean, I know of some people that I know that had to sell their house because on a short sale. And basically, a short sale it's not that it's shorter amount of time. It's basically that the lender is taking less money for the house than it's worth. Okay, so that's why it's called a short sale. But it takes a long time to get through that through the through the lender's back office process. I mean, it takes 6 months to a year to get that done. So some people just walk away from the deal. Okay. So what is a forbearance? Okay, forbearance. Okay, so forbearance. You remember doing the 2020 pandemic? The federal government allowed people to skip payments, but it wasn't really for forgiven. It was basically attached to the end, or they can catch up, and they would have to pay that money back. Okay, so right now, we have less than 1 million mortgages in forbearance. Okay, so that means that people are actually paying off their loan. Now, the advantage has been that we also have, you know, over $54,000 in equity on an average home. So people have been taking that equity, selling their house, and getting into a better situation financially, whether it be renting or buying another property, to help them avoid any situations like that. So you know, that's one of the factors that I think why we don't have the same issue as the 2008 financial uh, situation. And if you look at, from May of 2020, just the number of loans on active for forbearance in millions, if you go down all the way down to January of 21, I mean 22, you see that it's talking about less than 1 million. So as you can see, many people have done different things to get out of their homes. Whether if they had them in forbearance, they've actually sold them, they actually consolidated loans, they took some of their equity. So that's exactly how we get away from that particular aspect of the financial crisis from 2008. Okay, so 89% of forbearance plans exited the program. That's great. They took the advantage that the government was giving them, and then they basically were able to get out of that process. Um, this is another tool that we didn't have back in those days when the financial crisis. This was not available back then. Okay, remember we talked about how equity was so low. Okay, so even if you try to sell it, get out of that property, their equity was so low, you sometimes would have to pay to get out of the property. Okay, so 43.7% have workouts or repayment plans with the lenders, so that's great. and 18.2% are still in trouble but have at least 10% equity. So if they're able to use that equity in a certain way to get out of that property, they're gonna do it. Okay, so um, the best thing that I would say is if you're caught in this situation and you want to get somebody's opinion regarding your property value at this current time, then give us a call. You see our number at the bottom of the screen scrolling, and we'll be glad to assist you in any way we can. I had a client that just refinanced their property, and we're going to be selling it. So she was able to take the money that she had on equity, pay some bills that she needed to pay, and now she's fleeing clear besides the new mortgage. But at the equity that she has on the house, she's going to be able to get more of that mortgage, more money out of that house when she sells and buy a new house. So it's very interesting what you can do when you own a home. See, you couldn't do this when you're renting. The best case scenario is that you get your deposit back when you move out. Okay, and what you've done to that landlord is actually help pay their mortgage down, because most of the time they're mortgaged. Okay, these are the rental properties are mortgaged most of the time. Okay, so just kind of give you a bird's eye view of the forbearance program. And so, as we talked about earlier, 43.7% workouts or repayment plans. 38.1% are paid in full. So as it goes right now, it looks like only 1.3% of short sales, deeds in lieu of repayment plans, and so forth. So there's some people that have actually just given back their home. Now, this is where I'm telling you. Instead, if you're part of this situation that you're 18.2% of the market is still in forbearance, and let's talk about how we can help you sell that home, get out of that situation, and even have equity, maybe some money at closing that will help you get in a better financial situation. There is no reason why you should allow the lender to take that house back, because when they take it back, they're going to sell it at market value, and that equity that you had on the house is gone. They will keep it. They're not going to give it to you. You just lost it. Okay. And if it's an average home compared to the average equity stake that we have in the country, it's about $54,000. So there's some that have less than that, but the average is 54,000. So let's talk about how we can help you maybe get out of that situation if you're in this situation. It's such a small market right now that I doubt that anybody listening to this is in this situation. But if you are, give us a call at 833-722-7853 so we can help you out. Okay, so this is another reason why I don't think we're going to have another bubble. Foreclosure activity is an all-time low. Okay, so take a look at the numbers. I mean, I'm sorry, 07, 08, 09, 010, 2010, 2011, 2012. Look at those numbers, and it's going down to 151,000 from to the high of 2.9%. I'm sorry, 2.9 million in 2010 to 151,000. This is amazing. This is amazing information. Okay, so again, this is a factor that was really affecting the previous financial crisis, and it's not a factor in today's market. Okay, so home prices and supply and demand. This is probably the biggest reason why I don't think we're going to have a bubble, or we're not encountering a bubble at the moment. Okay, so home prices are accelerating. Well, are they? Or home supply and demand, prices appreciation today? All of these factors come into play when you think about what's going on in the market and how soon should you get into it, because it makes a difference. Okay, so take a look at the price appreciation is accelerating. Okay, so if you look at January 2021, price appreciations over the last years, and a month by month comparison, 10% to 19.1% in January of 2022 compared to January of 21. So as you can tell, we have almost doubled, in appreciation. So That's a big factor when you take a look at the market today. Okay, so this is what I was talking to you about. Change in the last 17. So changes in the last several years. From we're gonna start with 2021 fourth quarter. Okay, and then we're gonna look at the last 5 years and change since 1991. Take a look at these numbers. Okay, this is just the the bare details. Change in the last 5 years is 17.5% increase in the last I'm sorry, that's the last year. In the last 5 years has been 54.5% price increase. Pricing since 1991, 258%. That's crazy. Okay, that is just amazing numbers there. This is why it's such a good time to buy a home. Okay, look at this. Okay, changes in price. Okay, look at across the nation. Okay, across the nation, there has been an increase in prices. Okay, so that's a lot of equity. If we take a look at prices in the last 5 years, national average has been 54.5%. That's a national average, and there's some states on here that are even higher than that. Okay, so this is where you can actually look at Utah, 91%. Okay, Wyoming 42, Washington 77%, 118%. These numbers is just amazing. Okay, if we take a look at the numbers since 1991, on average, it has been 258%. Take a look at Texas, 292% increase. Look at Florida, 355% increase in prices. So Colorado, Utah, Arizona, all of these, every single state has an increase. So, ladies and gentlemen, prices are going up. Okay, supply is going down. So the supply and demand factor comes into play from your basic economics classes. Okay, so what are the forecasts? Price forecasts for 2022? We've talked about several of these companies. They're all different experts that provide input in regards to forecasting for, prices and price increases. So it goes from Zellman, always has been the really lowest one. I'm not really sure if they had any of them right, but it's one of the factors that we got to take into play because we're going to try to figure out what's the average. So Core Logic is always typically the highest, but at 9.6%, and then Zellman's at 3.0. On average, on all forecasters, we're at 6.1% increase for 2022, and I'm seeing that on the streets. So very very active market. So, homeowners is homeownership a strong investment? If you're looking for an investment that increases since 1991, if you would have bought a home in 1991 here in Texas, you had a 292% increase in price. Wow. That's okay. How many of you out there right now in the market, whether you be in bonds or stock or even any other type of investment, that you've got a 292% increase? Very few, if any. Okay, so definitely not in your bank. Yeah, you're not getting anything there. Okay, so uh, you know, two key things: homes did not depreciate in any state. Let me say that again: homes did not depreciate in any state. So, what is the move going forward? What should you expect? Okay, so new listings are still falling, ladies and gentlemen. So, let me tell you something. If you have a home, okay, that you use it as you investment property, okay, you have a house for like you're renting it, or it's your second property. Maybe you have it in Texas somewhere, and you bought it as an investment. This is the best time to cash out. Okay, not only will you make money, but you will get recoup every single penny that you spent, and the added value has been the rent that you've been paid through all these years that you've owned the property if you're renting it, and your mortgage is so low, if any, that you could end up with a lot of equity in your account, and then you can use that money, that capital, for something else. Okay, but this is drastic. Okay, so In thousands, if you can see that just the numbers in itself in January, 228,000. Now we're at 232,000, 232,000. Ladies and gentlemen, this is very, very difficult times for buyers because sellers are not selling. And if you have a second home or a third home, this is probably a very good time to sell. Okay, so active listings drop again. Okay, so active monthly listings count in thousands. If you look at that in January of 2021 and to compare to December of 2021, you can see those numbers continue to drop. And so inventory of homes, nothing like last time. Take a look at that. Remember, we told you we had so many houses last time. In 2007 there was 9.6, and this is in million. Okay, so 2008 9.4. So if you look at now 2018 3.7. I'm sorry, this is months of inventory. So it's nothing like last time. Okay. So, what is the net worth? On average, homeowner has a net worth of $300,000, whereas a renter is $8,000. Now, remember what I told you. If you move from one rental to another, the best thing that can happen is that you get the deposit back. Okay, that's it. And then, because if you don't own it, you don't get the equity. So net worth of a typical homeowner is about 40 times the net worth of a renter. That's pretty amazing data. Okay. So while the booming housing market contributed significantly to the recovery of the U.S. economy, research has consistently shown that homeownership is also associated with a multiple economic and social benefits of individual homeowners. Homeownership has always been an important way to build wealth. Now, how is that? You may be asking. If you're not very familiar with the process, you may be asking, how is that? Well, let me tell you. If you own a home, okay, and it has appreciated, let's say you bought it in, 1991, and now you're selling it in 2022 in Texas, on average, it's 292% increase in price. You sell that, house. What do you think is going to increase? Your bank account, your wealth, your total wealth. Okay. So this is what we're talking about. Renter, deposit. That's about it. So, in closing, I just wanted to let you know that we do have our spring buyer and sellers guide. They're now available for free for anybody that reaches out to us and asks for them. We'll get you a PDF copy of it, and we're gonna put them on our website, so you'll also get them there, be able to download them and get the information as soon as possible. So just keep in mind that if you need to contact us, okay, we have some numbers that we want to give to you. Our telephone number is 833-722-7853. Our email is info@premiercastlrealty.com. We have two websites, premiercastlerealty.com and premiercastlerealty.co. You can also reach us on social media. You have our links down at the bottom. And don't forget, we have the seller and buyer's guide for you, so you can enjoy that information if you should have some questions. So let me see if there's any items that I missed that I want to make sure I talk to you about. No, I think everything's good to go. So if you have any questions, give us a call, 817. I'm sorry, 833-722-7853. Thank you so much. Have a blessed day.